So the latest UK inflation print was on the 22nd of May, and that had fallen from 3.2% to 2.3%. That means inflation is falling, but it does not mean that prices are falling. It just means that prices are rising still, just more slowly than they were before. Now, if this is a good thing, why are interest rates still so high? So I'm going to go through a quick explanation of what inflation is and what are the causes of inflation, how this can be managed by the Bank of England and other central banks, what that means for all of us, and importantly, how much pain are we going to have to endure and for how much longer. We're also going to take a quick look at what the next few years might well look like. And I'm going to use the Bank of England's own charts and data to shed some light on where we are at the moment and why it seems we need to endure a little bit more pain for longer than we thought. Welcome back to the channel, and if this is your first time, a very warm welcome to the Economies channel, where together we're going to learn the language of money and wealth. We're also dedicated to mastering money and making financial wisdom available to all. But before we start, I'm going to put up the usual disclaimer to state that this video is for education and entertainment purposes only, and shouldn't be misconstrued or misunderstood as giving financial advice. So in its most simple form, inflation is where there is more money in the economy than there are things to spend it on. With people and businesses having more money, this increases demand to buy new things, and this drives prices ever higher. Now, if the goods needed to make these things are also in short supply, this can also result in a lot higher prices too. Now, we saw this after the pandemic when a lot of money was created and printed electronically by the Bank of England. And UK households also had excess money saved, maybe the first time ever. And the ONS estimates that this amount of savings was as high as £138 billion. So with more money in the system and more money to spend, this drove prices higher. And this combined with difficulty in getting hold of some of the goods, such as microchips, timber, car parts, consumer goods like exercise bikes, do you remember that? Building materials such as cement and steel. And all of this contributed to prices rising. For example, if you imagine it's a glorious sunny day and you've seen an ice cream van and they are selling 99s for £2 each. Now, for those watching from abroad, this is an image of what a 99 looks like. Then a month later, the cost of milk, sugar, chocolate, fuel and electricity has increased. So now the cost of a 99 is not £2, but £2.50. So when you've got more money, or more of anything for that matter, the value of that item will fall because effectively it's been diluted. And this doesn't matter if it's company shares, the money in your pocket, the salary you earn, or savings, or in this instance, ice cream. Your money has effectively lost value because there is more of it in the economy, so you need to use more of it to buy the same thing. Now, inflation is calculated by using over 700 items in a basket of goods, and there have been some new additions in this basket recently to include air fryers, vinyl music, which is clearly making a comeback, gluten-free bread, and edible sunflower seeds. I mean, who knew? Now, the economy moves in a cycle and it will move from expansion or recovery and then into the boom phase. And then this is going to be followed by a period of contraction as interest rates rise. And then finally, that will then slow down and cause a recession. Now, interest rates set by the Bank of England will have a significant impact and influence on this economic cycle. Now, the higher interest rates are, the less money there's going to be sloshing around the economy due to less money being borrowed. And in these circumstances, people tend to save more and to spend less. And this in turn slows down the economy and slows down inflation. Now, Warren Buffett said that high inflation acted like gravity on share prices. And that means with lower demand, companies make less profit, they pay less dividends, and then of course the share price will then fall accordingly. So I'm going to go through some slides now from the Bank of England report, which was released on the 9th of May 2024. The Monetary Policy Committee, or the MPC, are responsible for setting interest rates, and they're made up of 9 people who meet every 6 weeks or so throughout the year. At the last meeting on the 8th of May, they voted 7-2 in favour of keeping interest rates at 5.25%. Now, 2 members voted to lower interest rates and no one voted to increase interest rates. Now, we need 5 members to vote to lower interest rates before that can actually happen. So I'm now going to demonstrate why we should expect some more financial pain to come in 10 charts or less. But before we get into this, if you are enjoying this video, then please give it a thumbs up, hit the like button, and of course, subscribe to the channel. So I'm going to put chart number 1 on the screen, and this is a breakdown of how inflation is calculated. You'll see from the white line, this is CPI, and you can see the peak was in October 2022 when inflation in the UK was 11.1%. And you can clearly see the white line falling down and reducing over time as inflation has started to fall. So what makes up this inflation print? Well, we've got there other goods. Now, other goods are, in short, imported goods into the UK. We've got electricity and gas, and you can see those orange bars did make up a high portion of CPI. So you can see the food as well in purple, and that combined with electricity and gas was a big component in driving inflation higher. But if you look at the 2024 year on the right hand side of the screen, you can see that the purple bars are now a very, very small part of how inflation is now made up. But also that electricity and gas are now negative impact, and they are now bringing the rate of inflation down. You can see in the second chart, well, this is the projection for where inflation is going to go. You can see that in the first quarter in 2024, the level of inflation was 3.5%. And now as it stands at the moment, it's just 2.3%. So you can see on the orange line how it started to fall over time. And now where we are in 2024 with the orange diamonds, that's where the projection is going to be out for the foreseeable future. Now let's have a quick look at chart number 3. This is the unemployed statistics to the vacancies that are being advertised. Now, clearly in October 2022, you can see there on the right-hand side of the chart in blue that there was about 1 job advertised for every unemployed person. Now that has started to fall and it's now 0.6. So what that basically means now is for every 100 unemployed people, there are 60 job vacancies. And that indicates to us that the recruitment of companies is now starting to slow down. This is chart number 4, and we're going to focus on the blue or the teal colored line. This is actually private sector pay, and you can see the services sector is about 6%. Now, inflation is made up about 50% of services costs. So if this stays high around 6%, that could mean that inflation is going to be stubbornly high for the foreseeable future. Chart number 5 is the projection for GDP, which is the size and the growth of the UK economy. Now you can see here this information is a little bit out of date. The projection was to be about 0.2% growth, but in reality, last week there was the print for the GDP growth, which is a surprise to the upside of 0.6%, and I've put that in a purple dot at the top of the chart. What that means is recent data in the UK is now outperforming a lot of the other members of the G7, such as Japan, Italy, the States, Germany, France, and Canada. And that is surprising for a lot of commentators. So chart number 6, this refers to the cost of borrowing for lending in the UK. So despite interest rates remaining unchanged for some time, if you look on the left-hand side of the chart, you can see that mortgage rates have started to fall and there's been a slight uptick recently. So those with a 90% mortgage will actually have a higher interest rate because that presents a slightly higher risk to the lender. Those in the orange line with a 75% mortgage rate, their interest rates are slightly lower. But as you look on the right-hand side of the chart, at the very top, this is the cost of unsecured loans. So what we've got here is a representative credit card of around 25% per year, which is absolutely ridiculous. Now, it's also worthwhile mentioning that there's going to be an estimated 1.6 million people remortgaging this year, and they had interest rates of around 2% 2 or 3 years ago, and they're going to be remortgaging at around 6%. So what effect do you think that's going to have on these families and their affordability to maintain their standard of living? Please put your answers in the comment section below. So if you want me to put together a debt repayment video, which we can use either the snowball approach or the avalanche approach, please let me know in the comments below and I'd be happy to put a video like that together for you. Okay, on to chart number 7. We are almost there. This is about the projection for GDP growth in the UK. Now, it's going to be anemic. If you look at this fan chart, you'll see in the darker blue lines that it's expected to be between 1.5% and 2% a year only. This is chart number 8, and this is a projection for unemployment. And this chart is a lot more concerning. Now, due to the delays of interest rates actually having an effect, unemployment is expected to rise to around 5% from the current levels of 4.3%. So what that means is there's going to be a further 250,000 people losing their jobs every year for the next couple of years. And on to chart number 9. As you can see here in the orange line, this is a projection for CPI inflation going forward for the next 3 years. You can actually see there that their best guess is their projection is going to be at or around the target level of 2%, at least for the next couple of years. And finally, chart number 10. This is a summary of what we've just been talking about overall. We're looking at GDP rising over the next 3 years, inflation being fairly stable, unemployment is going to be rising, and interest rates are expected to fall steadily to around 3.7% in 2027. So in conclusion, despite inflation looking like it's getting under control, interest rates are likely to stay higher for longer, meaning more financial pain for millions of borrowers in the UK. Some businesses will close and many more will lose their jobs. Now, a lot can change in a short period of time, so I'm going to run similar videos to this every quarter when the inflation report has been released. So how do you think inflation and the economy is going to look in the next few years? Is there hope for us at all, or are we all screwed? Let me know in the comments below. So if you've enjoyed the video, please hit the like button and the notification bell and subscribe to the channel so we can get this financial wisdom as far and as wide as possible. And finally, this is your channel and this is your voice. So if you've had a positive experience or even a negative experience around inflation or mortgages and how it has affected you and your family, please let me know in the comments below and we can all learn together. Thank you for watching to the very end and for your time and for your patience. And I look forward to seeing you all again next week.